Good to have you with us this morning. Let's kick off our coverage this hour with the latest on Canada's jobs picture. The country unexpectedly shedding jobs for a second straight month in July. Canada losing 2,800 positions during the month. Economists were expecting 25,000 jobs to be created. The numbers point to an economy that is struggling to create new employment, while the unemployment rate itself did not rise as some on Bay Street thought it might, holding at 6.4%. Versus a 6.5% estimate. That number is still well above where it sat at the start of last year. The numbers likely leave the Bank of Canada on track to continue cutting interest rates. Remember, Bank of Canada Governor Tiff Macklem lowered the policy rate by another 25 basis points in July. One of the questions to ask with a report like this is whether or not the job market is cooling at a level that would make this a so-called soft landing or something worse. And obviously, that's the balancing act that the Bank of Canada will have to deal with. Remember, a week ago, lackluster U.S. job numbers immediately sparked recession fears stateside and some finger pointing at the U.S. Federal Reserve for being late to the party in changing course on rates. We're going to have full coverage of this data throughout the program. Let's kick off our coverage with Earl Davis. He's head of fixed income and money markets at BMO Global Asset Management. Earl, it's great to see you. Thanks for joining us.
Pleasure.
Your immediate reaction to the Canadian jobs report?
My immediate reaction was that it was weak, but my secondary reaction is that the number's actually better than it looks. And the reason why that is the mix between part-time and full-time. There was a significant increase in full-time jobs, significant decrease in part-time jobs that resulted in this overall loss. So it tells me, you'd rather have a full-time job than a part-time job. So it's actually a little bit better than expected. My other takeaway from this, and there's two important elements that I look at from a Bank of Canada perspective. One is, what's your unemployment rate? Above 6.5% unemployment, they accelerate the pace of eases. We stayed at 6.4. So that's on course, as you said, on track for 3 cuts possibly this year. The other number I look at is wage inflation. The Bank of Canada not only wants to see that below 5%, they want to see it trending down towards 3%. We had wage inflation that was lower than last month's print, 5.6 to, I think it's 5.2, this one, but it's still above 5%. That's a magic number as well, too, from a Bank of Canada perspective.
Magic number in terms of a so-called soft landing scenario?
Yeah, there's a magic number from two fronts. Yes, that so-called soft landing, but earlier this week when we had all the volatility in risk assets and equity markets, there was some talk of a 50 basis point ease by the Fed, which puts a 50 basis point ease on the table for the Bank of Canada at any one of their meetings. That is not on the table now. But if we see either wage inflation go below 5% or the unemployment rate above 6.5%, I think you're going to get some talk of a possible 50 basis point cut.
The broader backdrop for all of this is that in a higher interest rate environment, Canadians are feeling stretched. They were already navigating inflation, a lot of people struggling with the day-to-day costs. And then, of course, when you think about interest rates, you immediately think of the mortgage market and the wave of renewals we'll see over the next few years. One of the things we've heard as part of this balance that our central bank is trying to navigate here is that if people are generally still employed, then that helps. And if they, being the Bank of Canada, see some trends that would allow for rate cuts, that will be an extra help, assuming people are still employed. There have been some suggestions that you're not seeing widespread layoffs across the country. The people who have a job have been able to hold on to that job. It's just that there's not a lot of new job creation. So does this data reflect that to a certain degree, in your opinion?
On a standalone basis, yeah, but let's not forget about inflation. So let's go back to the Bank of Canada. They said neutral interest rates, where it's neither restrictive nor stimulative on the economy, is 2.75. We are presently at 4.5. So by definition, that's restrictive. So then the question is, why are they not easing to neutral faster? Only one reason: inflation. So when I say the wage inflation in the employment number, that's a representation of inflation in employment. And that's what they want to see decelerate. If all of a sudden we go from 5.2 to 3.9 in wage inflation, like we're seeing in CPI, that lowering, they will accelerate their pace of eases.
We also we have to talk about. You talked about full-time versus part-time, but there are demographic and sector stories in the jobs market that are worth considering. First of all, people who are just coming out of school right now are having a reasonably tough time getting a job. Even summer jobs has been a bit of a challenge for people. So youth unemployment has been notably high. We've talked in recent months about for new Canadians, right? Immigration is a key part of the Canadian growth story, but there are a lot of people who are struggling to find employment. So there's a bit of an imbalance there when it comes to the overall employment rate, depending on who you are. And then one of the interesting things with this report is you're seeing more government jobs created. And over the last 5 or 6 years, we've seen a huge surge in the government employment picture. But I wonder if that can mask what's actually happening with the economy. How do you feel about an economy that is creating a lot of government or public sector employment? Is that a good or a bad thing?
It depends on what seat you're in. So from an economic, purely economy perspective, I would say it is not a bad thing. And the reason why, those are typically higher wage jobs, which means there's more disposable income. It means people spend more, keeps the economy going. From a sustainable perspective, it's not the way you want to go, because more government jobs means more taxes. It means they have to increase the revenues to be able to support it. That's why you want to be able to be supportive of the private sector. You want the private sector to lead jobs, without a doubt, not the public sector. But it's a balance, and it's complicated. And this is why I do think the governor is doing a very good job, because you still cannot take your eye off inflation. Even though it's declined and we're not talking about it as much, you cannot take your eye. And that's why they're being, I would say, measured in their approach of easing. And I expect that to continue.
Okay. Looking ahead in the market this morning, we already mentioned there's some weakness in the Canadian dollar, although that's generally been the trend recently. There are growing expectations, as you look out for more rate cuts. With this data point today, what's your current view on what happens with interest rates from here?
Yeah, so my current view is there's 3 more Bank of Canada meetings in 2024. I expect they're going to ease 25 basis points at each one of them, with a possibility of 50 at one if we see a return of the volatility we saw earlier this week. The other thing to look out for is the Fed. The Fed right now, they start easing in September is what the market's anticipating. And the base case is that they ease by 25 basis points. If they start with a 50, that puts a 50 on the table for Canada as well. So we do expect that easing trend to continue. We do expect to see 375 by the end of the year, with ongoing eases next year to get to neutral. Neutral is in play by the end of 2024, which is 275.